They go on to say bucket shops emerged after the Civil War. Usually, they were storefronts where people came to bet on stocks without owning them. Unlike their customers, the shops actually own blocks of stock. If customers were betting that a stock would go up, the shops would sell it and the price would plunge. If bidders were bearish, the shops would buy. They cleaned out their customers. Frenetic bucket shop activity caused the panic of 1907. By 1909, New York had banned bucket shops, and every other state soon followed. In the mid-1990s, the credit derivatives industry argued vehemently for exclusion of all state and federal anti-bucket shop regulations. On the side of industry were Federal Reserve Chairman Alan Greenspan, Treasury Secretary Robert Rubin, and his deputy Lawrence Summers. By the way, Lawrence Summers also was the head of the International Monetary Fund and the World Bank. Okay?
Right.
Holding the fort for the regulators was Brooks Lee Bourne, who headed the Commodity Futures Trading Commission. Bourne warned that derivatives trading would threaten our regulated markets or indeed our economy. Warren Buffett of Berkshire Hathaway also weighed in against deregulation, but Congress loved Greenspan, a.k.a. the Maestro, and the Oracle, and Clinton loved Rubin. Congress removed oversight of derivatives from the CFTC, and Bourne resigned shortly afterwards. Something odd started to happen. Legitimate big investors couldn't get into certain hedge funds despite the fact that they were willing to pay high fees. It seemed as though these funds did not want fussy outsiders looking into what they were doing with derivatives. This was not caused by imprudent mortgage lending. The vast majority of homeowners paid their mortgages. Much more dangerous was the notorious building or bundling of mortgages. Investment bankers gathered these loans into batches and turned them into securities called collateralized debt obligations, or CDOs. These securities were then rated by Standard & Poor's. Oh, I must say this. Many of your bond rating houses have direct ties to CIA. That's why Enron, which was giving AAA ratings by some of these ratings agencies like Standard & Poor's and Fitch and Moody's, okay, they couldn't have done what they did without these rating agencies, which would allow for the lending apparatuses, the banks and things like that, to give them the money to continue this process, okay? That's important for people to know. Because when Harold Washington was the mayor of the city, they were going to get him to knuckle under their thumb. When he went to New York, he had to go to Lazard Perez. Do a search on that. Lazard Perez, which was headed by Felix Rohatyn. R-O-H-A-T-Y-N. Felix Rohatyn. He's a Rockefeller boy, okay? They basically lowered the city's bond rating, which made it hard for Harold Washington to do the things that he wanted to do here in Chicago before they killed him, okay? Because now it made it difficult for him to borrow money based on the city's bond rating. Every municipality in this country is nothing more than a corporation, and whether you're able to borrow money depends on your bond rating. You see?
Right, right.
Now, they go on to say here, banks like Wachovia, National City, Washington Mutual, and Lehman Brothers loaded up on the financial trash. Interestingly enough, today, those banks are extinct. Those are the mid-level banks that basically went under. The 5 big major banks that did this are still in place to this day. This is extremely interesting. This is on the next page. Check what they say here. About $2 trillion in credit derivatives in 1989 jumped to $8 trillion in 1994 and skyrocketed to $100 trillion in 2002. Last year, the Bank for International Settlements that Ben Bernanke, the head of the Federal Reserve Board, sits on. They say it's a consortium of the world's central banks based in Basel, Switzerland. They go on to say the Fed chair, Ben Bernanke, sits on his board, reported the gross value of these commitments, which is the derivatives, at $596 trillion. Some are due and some will mature soon. So now you can see that they said by 1992, the derivatives market was valued in excess of $596 trillion. So now you can see that this problem is almost insurmountable, and the reason that you're not getting these figures is because the people responsible for giving you the information are sitting on the Bank for International Settlements, or they come out the Rockefeller Foundation, like Tim Geithner, whose daddy sat on the Ford Foundation, who is also a member of the G30, the group of the 30 leading bankers on the planet, and some intellectuals who basically do the writing to contextualize what they want to do, okay? Now you can see, and I hope we've been able to outline, the interconnections between these things, okay?
Right.
Now, here's one last piece that I think people would find extremely interesting, and it should jog people's memory, because this process and this problem didn't just start. I'm going to jog people's brain. Check what they say here. This is in the same article from the Village Voice for January 28, 2009. They say here under the heading or subheading, the heart of darkness was the AIG, or American Insurance Group, founded by the CIA, Financial Products, or AIGFP, office in London, where a large proportion of the derivatives were written. They go on to say here, AIG had placed this unit outside American borders, which meant that it would not have to abide by American insurance reserve requirements. The derivatives clerks in London could sell as many products as they could write. The president of AIGFP, a tyrannical super salesman named Joseph Cassano,